All right. Hello, everybody. So we have a clip here. This car costs more than their house. Uh-oh. Let's see what's up.
What car do you have? What car do you possibly owe $46,227?
I have a 23 Jeep Gladiator Mojave.
Why do you have a $46,000 car?
Because her scat pack got totaled.
You have a $1,362 monthly payment on your Jeep?
Yep.
No, that's not the number, is it?
It's more than the house
Is
payment.
that the number? The number on screen?
This is for the Jeep?
Oh, dude. What do you think that car is worth?
I'm gonna say 30 something.
Okay, $15,990. Also, you're past due by 4 months. What car do you have?
Oh no. I'm surprised they didn't take her car after being past due 4 months, but I've never had my car towed or repossessed. But yes, we actually did a scenario yesterday where someone had that same amount, auto loan 46,000, and we also assumed that they were a nurse. So, why don't we just do this again? And if you take a look here, the student loan, or not the student loan, the auto loan, is $826 here, but the mortgage is $1,400. So I'm assuming that if they started out with a much bigger balance, and dang, that's a really expensive truck. Actually, let me go back a little bit here. Yeah. So that's the current balance. I'm assuming the original balance was much bigger if the payment is that big. So yeah, probably been paying for 3 years. Dang. Did you see Caleb's face? He's just like an OMG face. He's been doing this for like 3 years. Yeah. All right. Well, probably 4. But let's go ahead and get started and just pay off $46,000 of auto debt. And the difference between this scenario and the one we just saw is that here the starting balance was probably smaller, but that's kind of crazy that people would pay that much for a Jeep. Oh my goodness. Yeah. And then we haven't paid in 3 months. Amount of last payment. This one is like we tried to pay it, but not the full payment amount. Sorry. All right. Let's go ahead and get started with paying off debt using something we call the velocity method. And if you don't know what it is, it's basically a debt payoff strategy where we don't save money. So you see this checking and savings, that's negative $339. What we're going to do is put this into a 0. So even if we were positive, even if we're negative, it doesn't matter. This is just going to be 0 for checking and savings. And what this means is that by the end of the month, intentionally, we're not saving any money. So why do so many people have trouble paying off debt? It's because they're taught 2 things that are contradictory. Number 1, you have to save money. Number 2, you have to pay off debt. Well, I'm going to give you a newsflash. Paying off debt requires you to not save money, right? That's literally all it is. And so what we're going to do is we're going to have the same income and then the same expenses. Okay. And then I'm going to do this. We're going to increase our cash flow. So the cash flow is the amount that our line of credit, something called our line of credit, decreases every single month. So think of it as the amount that our debt will decrease. Now, right now, it's increasing by negative $339, but if we change the flow of money, we should be able to make this into a positive, right? And so if you take a look here, we have 6 credit cards, an auto loan, a student loan, and a mortgage, okay? And actually, let me just do this right here. So let me redo this so we can restart. And we see that we have a lot of debt. So this strategy will work if you have a lot of debt and you don't have that much expenses, if that makes sense. So in real estate investing, there's a term called net operating income. And then there's also a term called cash flow. So net operating income is like your income minus your expenses, and they completely ignore the debt that you have, right? Whereas cash flow is income minus expenses minus debt. And as long as your net, quote, your personal net operating income number is, positive, or has the potential to be positive, you should be fine, right? If that number is negative, then the strategy is not going to help you, right? Because we're assuming that your cash flow is screwed up because of debt itself. And if you were completely debt free, you would be fine, right? That's like the assumption that we're making. Now, another assumption that we're going to make is that we'll have access to a line of credit. So if you don't know what a line of credit is, basically a financial tool where you could borrow money, pay back, and then use it over and over again. So let's assume that we have a $200,000 home equity line of credit. Now, there are different types of lines of credit. There's personal, home equity, business. And the reason why we're using a home equity line of credit is because realistically, it's the line of credit that will give you the lowest interest rate and the highest limits, right? That's kind of like the criteria you want to use. Now, if you use a personal line of credit, you're probably going to get a sum around maybe $20,000 to $30,000 at most. If you have a really pretty good profile, and it's probably going to be a 15% interest rate because you're not putting your home as your collateral for that line of credit. Okay, so that's pretty much the difference between personal and home equity. Is that home equity you have security, you have collateral, and that's why it'll give you a lower interest rate and a higher limit, right? And so what we're going to do here is we have something called the cash flow index, and what we're going to do is strategically move debts into the line of credit. Now, a credit card is technically a line of credit, right? But it's not as useful, especially in the beginning, as the personal or home equity line of credit. And why is that? It's because it's the only tool, the line of credit is the only tool where you could dump your entire paycheck and then immediately take out your expenses like the next second, right? Whereas with these credit cards, I could put my entire paycheck into a credit card, and I can't use credit card one to pay the other credit cards, the auto loan, the student loan, the mortgage, right? I can't do that. That's why we talk about using, a personal or home equity line of credit, and then a business line of credit if you got a business. But if you have a business, your situation, I'm assuming especially if you have a lot of revenue, will get more complicated because you just have a lot more moving pieces than, let's say, on the personal side, right? But even in a business line of credit, like you probably be able to get a lot more funding, just probably at a higher interest rate, um, because you have a lot of revenue. And a lot of companies just look at the revenue number; they don't even look at profit, and then they'll be willing to lend at that usually, right? Okay, so one other thing I want to address, the elephant in the room, is that if you are negative $339 left over, will the bank give you a free and clear $200,000 line of credit? The answer to that is no. And why is that the answer? Is because banks don't lend money to people who need it. That's right. Banks don't lend money to people who need it. And if you're a bank and you see that a person needs money, you're going to freak out and run the other way, right? Because here's what a bank is: it's essentially a leech or a vampire. And when the leech or the vampire sees that your blood has been sucked by all the other banks, right? All these credit cards, auto loan, student loan, mortgage, and you only have negative $339 left over. Well, the vampire is going to say, "What's in it for me? There's no blood to suck. Where's the interest? You're not going to make the interest payments that I desire in order for me to sustain myself, right?" And a lot of people don't realize this, but that's really why banks don't lend money to people who need it. Another reason why banks don't lend money to people who need it is because people who need money don't pay you back, right? So if you ever had friends, family members, say the magic words, I need you, I need to borrow money because I need the money. That means they're not going to pay you back. And the bank knows this because they've been burned many, many times, and they still get burned, chase infinite money glitch, right? Stuff like that. All right. So now let's go ahead and move some debt strategically into the line of credit. So you might be thinking, well, if you don't get a free, clear line of credit, why are you demonstrating this? It's because if we did a realistic scenario where people had all this debt, usually what happens is they have a maxed out line of credit. I'll be here for like 1 hour and 30 minutes, and this is a live stream I actually did. It's members only, and I'm just going to demonstrate this in about 20 minutes. Okay, 20 minutes, and you'll still get the point, which is why I demonstrate the free and clear line of credit. Okay, so before we start freeing up our cash flow, we have to do something called a cash flow index, right? So it's just a formula of the debt divided by the monthly payment. You do it for all the debts, and you think of this as a system where you're ranking the debts, and you want to pay the lowest ones off first, and then the highest ones, right? You want to pay that one off last. So why do we pay, let's say, the 30-year mortgage last? Well, I'll tell you why you pay it off last. It's because this high number means you get very little bang for your buck when you pay off the loan. So I literally had to give someone $300,000 for only $1,400 of cash flow. Okay, $300,000 for 1,400 is not a lot, right? Like if I pay these two credit cards, I automatically get more cash flow than the mortgage. So why not pay off the credit cards, get that cash flow, and then apply it to the next loan based on the order of the cash flow index? Now there are some nuances that where I kind of make exceptions. Like if you have a 0% loan with a low cash flow index, I just say make the minimum payment, right? Things like that. I don't really like. I'm not too strict on it. I have some other exceptions too. I can't think of it at the top of my head, but if I go through a realistic scenario, I'll know it is. But yeah, I just use this as like the first general direction as to how to pay off my debt. And I literally did not start using the cash flow index until like people started sending me their real life scenarios. And it's like, holy, like this is 22 debts. And I was just like, how do I know which one to pay off? This is too much, right? And then, cash flow index. Wow, it made my life so much easier, right? This is why I love it, because most people's scenarios are not just one or two debts, and if it is, congratulations, you're much better off than the average person who has like a bunch of debt and is kind of faking it. They're all faking it, okay? And anyone who tells you that they're successful in they're faking it. Like I'll 90% of them are faking. I'm gonna be nice. I'd even say 98, but I'm gonna be nice here and say 90% of people that are faking if they tell you they're successful. Okay. All right. So now this is what we're gonna do. What we're gonna do is just move these low cash flow indexes into the line of credit. So it's 5, 8, 15, 27, 37. So we're summing up the credit card balances, and that's $92,000 of credit card debt. So I'm gonna do this right here. So 92000. And then guess what happens when we move this credit card debt into the line of credit? Okay, I'm going to show you something mind-blowing. You see how we start at this negative $339? Well, don't these payments magically go to zero? Yeah, I know, right? They magically went to zero. Yeah. So now, without making more income, and just kind of take a look here, right? Let's go ahead and zoom in on this. You see how the income is the same, but because we didn't save money and we strategically moved debt into a line of credit, that we literally went from a negative to a pretty big positive, even though we have good income and this should even be more positive, but this is still a pretty good positive starting from negative $339, right? So yeah, I mean, here to here. And yeah, I mean, like, this is the part where I would just stare at it for a moment and think, is this real? Do you ever think that? Like, I think I've done demonstrations where you go like from a penny to like over $5,000 in the instant. And I feel kind of bad for sometimes for like presenting this, or I have in real life where I just presented it. And then, I thought people would be like super amazed, like, oh my goodness. And then they would never, like, most people wouldn't sign up. You know what I mean? Like, you want to sell a program at the end, and then they just kind of don't sign up. Folks, what's funny is that I think when you show like actual results, people just don't want to believe it. I remember like watching this documentary like a long time ago. I think it was probably like the 2008, 2009 or something like that, about like people having their cancer cured, by like alternative medicine, juicing, coffee enemas. And I remember like there was one who gave like a testimonial how she went to like her oncologist or something. And because, a lot of people who try alternative medicine, they try like the conventional medicine first because that's like the default, right? Like, and it doesn't work. And because, if you know what chemotherapy is, it's basically mustard gas, right? Like it's basically World War One weapons, basically, that they saw that, hey, if you put mustard gas into like soldiers, their cells stop like multiplying or something like that, right? And that was kind of like the basis of using chemotherapy to patients, and that's why like people lose their hair and stuff, right? And again, I'm not a doctor, so I can't give medical advice. I'm just telling you what I saw in the documentary. And so this lady, when she was like, she had her cancer recovered or whatever term you want to use, she went to the doctor, and the doctor was like, "Yeah, we can't do anything with that." You know what I mean? Because they're kind of restricted of what they can do by the medical system. And so there have been cases of people who like went against the medical system, especially if you're a professional, and then they got they got their, I want to say, ASS um prosecuted by like the medical board of the state. In fact, I think there was a Polish guy. Wasn't there a Polish guy? Hold on. I know I'm going off a tangent, but let me just look for one thing. Yeah, there we go. I don't know how to pronounce his name. Stanislaw Brzezinski, a controversial Houston-based physician known for pioneering, I don't know what this word is, anti-neoplaston therapy, an alternative cancer treatment using peptide derivatives and amino acids. And then if you take a look here, you see that he faced numerous legal challenges, FDA warnings, and indictments. So basically, this guy, after 7 days deliberation, failed to reach a verdict for the trial of Dr. Stanislaw Brzezinski. And so, anytime, I'm not saying like, oh, I don't know anything about it. I just remember reading on the news. And again, I have to say this, I'm not a doctor, so I don't know, I don't prescribe medicine, right? I just read stuff, and then I just repeat the stuff that I read. Anyways, so yeah, things like that when you go against the grain, and then you share things like, hey, look at this. I think people just don't believe and want to move on. Like that's kind of been my experience, just like sharing this. So this is why, like, when I talk about this online, I don't expect too many views, but I do expect when people get it, they'll be like, they have this aha moment. You know what I mean? Okay. So now this is the final thing, which is you're going to put your entire paycheck into the line of credit, take your expenses out, and then rinse and repeat over and over again, right? Paycheck in, expenses out, rinse and repeat. And then after every single month, your line of credit balance should go down about $2,700. So let's go ahead and do that. So to get the next month's balance, it's based on the previous month's balance, previous month interest, minus our cash flow. Okay, and then what we're going to do is we're going to take the average daily balance, multiply it by the interest rate, and then divide by 12. And I'm going to go ahead and copy and paste, right? And let's go ahead and copy and paste all this. And then we see that in month 39, a little bit more than 3 years, we're credit card free. Now that's not, I know someone might think 3 years to pay off credit card debt, but yeah, you literally started off at the negative and you didn't have to declare bankruptcy, right? So let me just kind of go here, and then this is going to be 92K, and then this is going to be, how much was that? 39 months. Okay, I'm going to copy and paste this. Now we have the auto loan, student loan, and the mortgage. So we're just going to assume this person's a nurse, which is why we have the big student loan. But if we didn't have a student loan, all we had was credit card debt, we'd probably be better off. But let me just kind of go here and copy. Whoopsie. Let me reset this. And then be 39, 39, 39. Okay, so this is the current debt that we have, which is the auto loan, student loan, and the mortgage. And then this is the current, at 39 months, what's the debt, the current balance of the debt. And then we have the cash flow index, right? Whoopsie, let me go back here, and we just follow it, right? So a lot of times people would focus on, why don't you focus on the 7% interest rate? OMG, see that on TikTok, right? And the reason why we don't follow that is because we just immediately interested in paying off this loan. Now, technically at this point, this is the snowball method, right? So snowball cash flow index at this point is the same thing, even though philosophically there might be slightly different. But what we're doing here is that we're going to pay off the 16 grand to get $826 of cash flow rather than 100 grand to get 1600, right? So that's why we're focusing on this one at 3%. And so we can immediately focus on getting the cash flow for that debt. Okay, so I'm gonna just do this right here. So see plus 16889.43. Okay, and I'm just gonna do this. This is gonna be 0 auto loan. Okay, and then now we have $3,500 cash flow. And all right, let's go ahead and do it. All right, this would be 0 and minus 3542.24. And then I'm gonna do this. Whoopsie, I screwed up. Instead of doing control V, I did control B. All right, so now this is paid off in 44 months, right? 44 months. This has been completely paid off. Okay, so that'll be 92 plus 46. That's gonna be 138K. Bam! Alakazam. All right. All right, so now student loan mortgage. All right, let's just do this right here. All right, so 44 months to be 44, 44, and then this would be 0. And then, okay, so this is gonna be 99 grand, and then we're just gonna follow the cash flow index. So pay this one off first. This one does have the highest interest rate and the highest payment and the lowest balance, right? So that's kind of like the criteria that we usually want to look at. And so now we have two options, right? We can just move it to a line of credit or pay it off incrementally. I would say pay it off incrementally if there's a huge interest rate difference and this cash flow index number is high. This one, there's very little, just 1%, but it will probably be losing some money if we move into line of credit 7 to 8. But I'm just going to go ahead and do this right here. And copy and paste. Okay. And then be plus 99559.62. And then I'm going to just do this right here. And so we see that our cash flow is over 5,000 now. All right, so I'm going to do this right here. All right, so now it'll be 5167.75. So I did this last time, so that's why this number is there. And then we're going to copy and paste, and then we'll see that in 65 months, this was all paid off, right? 65 months, okay? And then I'm going to do this right here, and I'm going to do this 65 months, okay? So that's 140 plus 138. That's 278K for 65 months, all right? And then now I'm going to do this. The mortgage is 65 months. All right, 268,000. Okay, 268,000. All right. So now what we're going to do is we have two options. This is our final loan, right? So first option that we have is extra payments, which is just dumping our entire cash flow as an extra payment into the loan. And the reason why a lot of people have trouble with that is because anytime you overpay a loan or a credit card, you can't immediately get the money out like a line of credit, right? But that's just kind of like the initial reason why people have troubles just starting out, because they have a fear of overpaying loans. But at this point, if this is your only debt, your last debt, and you can do this, go ahead. The thing that we also talk about is using a line of credit. So a lot of people have a fear of using a line of credit to pay off the loan because like there's a huge interest rate, like 4 to 8, right? But if you do it in small pieces, then you won't have to, then you shouldn't be worried about the interest rate difference as long as you're paying it off in the right order, right? And so this is just kind of a comparison chart of extra payments versus what we're going to talk about, which is sweeping with the HELOC, incremental sweeps. And the reason why so many people have trouble doing extra payments is because you're going to end up with decision fatigue, right? Because a lot of people have this idea like, hey, I can't dump all of my money into a loan, even though you technically can, okay? Whereas when you use this method, I mean, what are you thinking about throughout the entirety of the debt payoff process is that your checking will go to 0 and then your line of credit will go to 0, which makes the execution much easier, right? So yeah, let me just kind of go here. And we have a calculator that shows us the payoff amount. So we'll say, hey, we'll take $9,000 of the loan. of here, move it into the line of credit, and I put 30%. um, and then this is our income, expenses, and then the expenses is everything except for the loan we're trying to pay off, right? So that's 3.8 years. And then yeah, so you see here it takes us 3.8 years to pay off, and a lot of times people fear, well, it's an 8%, and then you just kind of play around with the calculator right here. If I change this to 15%, literally double the interest rate, look how this barely moves. And then if I do like 30%, yeah, it moves, but just a little bit more, right? And I'll tell you what the biggest mistake of all this is that if you're going to use a line of credit, dumping the entire loan into a line of credit, you see that you end up paying more than you have to, right? So that's why you don't need to use a line of credit to pay off the entire loan. You have to use a little bit of what I call common sense, right? And this is now on my mind. Is this guy really from Poland? Where is he from? Yeah, Poland. I've had like 2 Polish people or people from Poland contacting me. One, but they're all in the United States. But I think that's interesting. Maybe they need to kind of spread this in Poland. But I heard that the Poland banking system probably is not like able to support all of the stuff that we're talking about from the Polish person that I know. Yeah. All right. So let me just kind of go here. So let me just do this. Blah, 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 blah. So where are we? 9,000, 3.8. And then I just got to write down here 0. So 65 divided by 12 plus 3.8. So that's 9.22 years, and then we're debt-free. Debt-free. All right. See how easy that was? So in 10 years, you ever watch those videos where it's like, be mortgage-free in 7 to 10 years? I mean, no. How about being completely debt-free at that time? You know what I'm saying? So, all right. Have a great day, everybody. It's the end of the video. And whoa, we're at the 27-minute mark. So this is just a longer video than we normally have. Okay, well, hopefully you see that debt payoff is relatively easy. Have a great day, and I'll see you in the next video.